first thing I want to talk about is the conversation about term and whole life. And I know this seems like a ridiculous conversation that we've had for like years and years, but there has to be, my logic here is there has to be a reason that smart, logical people believe in both sides of this debate. So, Rod, I'm going to kick us off. Talk a little bit about what the debate is, the term versus perm debate, kind of set the stage for us, and then maybe just define what they are too.
Okay.
Just do that really quick.
Yeah, let's start with that definition. So term insurance is pretty basic. If you want to have life insurance, in other words, if you pass away with an untimely death and you want your family to get money, get the life insurance payout, and you have term insurance, you're paying a premium, and if you die, your family gets the death benefit. And there are different times of term you can get: 10-year, 15, 20, 30. There's even what's called annual renewable term, where year by year you decide if you want to keep paying the increasing premium. But in any case, these are very purely insurance-based policies, probably more like the way we think about insurance in terms of, auto insurance or medical insurance, right? You have it for the just in case. And if and when that happens, the benefit pays out. But if not, if I don't die in the 10 or 20 years or whatever of my term insurance, which is, I'm hoping happens, right? I'm hoping I don't die. It's the what if.
That's true.
But if I don't die, then I've just spent that money and it's gone, and I paid the premium and I didn't die, right? No death benefit was paid out. That's term.
Okay,
we good
term
there?
Insurance, very simple. Yep, I think we're good.
Okay, on the permanent insurance side, basically what happened is, because cost of insurance goes up as I get older, and if I'm someone who wants to have insurance later in life, then permanent insurance is the right way to go. And basically what the insurance companies have done here is they've set it up so that the premiums that I'm paying for my insurance while I'm younger is higher than it has to be, or higher than it should be or would be if I was paying for term, because what they're doing is building a cash value inside of the plan. What that cash value does is it allows me to offset the higher costs later, so that I don't have to come out of pocket with this ever increasing amount of premium if I want to keep the insurance as I get older, because there's this underlying cash value that's there. It's growing along the way, so that when I get to those older ages, I can keep paying the same amount of money as I have been paying. And then this extra value that's in my policy offsets those additional costs, so I can keep the policy. Again, it's called permanent, right? It needs to last as long as I live, regardless of how long that is. Do you want to rent your insurance, or do you want to buy it? If it's term insurance, it's the same as renting. You have an apartment, you live there, right? It's serving the purpose, but you're not really building any equity. Whereas if you have a permanent insurance policy with this underlying cash value, it's like buying a home. You're still paying for it, but you're building equity inside of it. And in the long run, if you're renting, it's a sunk cost. You never get that back. Whereas in the buying analogy, you're building this cash value in the policy, and it's growing. So in the long run, you end up with a lot more value that you have access to and can bring back out than what you've put into it. Meaning, it's I'm not going to say no cost, right? That would be maybe misleading people, but you come out net ahead because you have more cash value than what you've put in.